The Federal Reserve didn't touch interest rates this month, your income didn't change, and yet your mortgage just got $312 more expensive. Here's the part nobody's explaining. Hey everybody, it's Billy here. If you're trying to figure out whether you should still buy a house, lock your rate, or just wait this whole mess out, you are in exactly the right place. I'm about to break down the real reason your mortgage payment just jumped $312 a month and walk you through 5 smart moves you can make starting today to protect your home buying budget without needing a finance degree, without spending a single extra dollar, and without sitting around hoping the Fed bails you out. Look, I get it. You did everything right. You saved the down payment. You fixed your credit. You found the house. And then, out of nowhere, a war on the other side of the planet quietly stole hundreds of dollars a month from your future mortgage payment. And nobody in the news is connecting the dots for you. That feeling of working hard and still falling behind, it's brutal. It's unfair. And honestly, it makes a lot of people just want to give up on the dream of owning a home altogether. But before you do that, stick with me for the next few minutes. Because today, I'm going to show you exactly how the Iran war just cost you $312 every month on your mortgage. And more importantly, what the smartest buyers are doing right now to fight back. Quick disclaimer. Hi, it's your friend Billy. Please note that this channel is for education and entertainment only. I'm not a financial advisor. This is not financial advice. Talk to a real professional before you do anything with your actual money. I'm serious. Don't be that person. All right, back to the video. Let's start with the most important question. How does a war happening thousands of miles away end up raising your mortgage payment? Because on the surface, that connection seems insane. Missiles in Tehran, higher interest rates in Ohio. What does one have to do with the other? The answer is oil, inflation, and Federal Reserve psychology. And when all 3 of those things move in the same direction at the same time, your borrowing costs go through the roof. Here's how the chain reaction works. The moment military conflict escalates in the Middle East, global oil markets go haywire. The Persian Gulf region is responsible for a massive chunk of the world's oil supply and shipping routes. When that region becomes unstable, traders and investors don't wait to see what happens. They immediately price in the worst case scenario. Oil prices spike, sometimes dramatically, sometimes within hours of a major development, and we've seen exactly that pattern play out again. Oil jumped significantly when tensions escalated, and that spike didn't stay in the oil market. It bled into everything else. Higher oil prices mean higher transportation costs. Higher transportation costs mean more expensive goods at every level of the supply chain. And more expensive goods mean one thing from the Federal Reserve's perspective: inflation, or at minimum, the threat of inflation returning in a serious way. And here's where your mortgage enters the picture, because the Federal Reserve has one major tool to fight inflation, and that tool is interest rates. When inflation threatens to run hot, or even when the fear of inflation picks up, the Fed either raises rates, pauses cuts they were planning to make, or signals to the market that easy money isn't coming anytime soon. Any one of those actions causes mortgage rates to climb. Mortgage rates don't directly follow the Federal Reserve's benchmark rate, though. That's a common misconception. Mortgage rates are most closely tied to the yield on 10-year Treasury bonds, but those Treasury yields are extremely sensitive to inflation expectations. When investors believe inflation is coming, they demand higher yields on Treasury bonds to protect their purchasing power. And when Treasury yields rise, mortgage rates rise right along with them. So the full chain looks like this. War in Iran, oil prices spike, inflation fears increase, Treasury yields climb, mortgage rates go up, your monthly payment gets bigger. Every single link in that chain is directly connected to the next one. Now let's put real numbers to this. Before the conflict escalated, mortgage rates were sitting in a range where a typical 30-year fixed mortgage on a median-priced American home was generating a certain monthly payment. When rates moved up by roughly half a point to a full percentage point in response to the geopolitical stress, the math changed dramatically. On a $400,000 home with a standard down payment, that kind of rate move translates directly into somewhere around $300 or more in additional monthly costs. Not over the life of the loan, every single month. And over 30 years, we're talking about potentially over $100,000 extra that you're paying to your lender that you wouldn't have paid if rates had stayed where they were. For people who were right on the edge of affording a home, this isn't just an inconvenience. It's a deal breaker. It's the difference between qualifying for a mortgage and not qualifying. It's the difference between being a homeowner and continuing to rent. And for people who already own homes with variable rate mortgages or adjustable rate mortgages, this is showing up on their actual statements right now. It's not hypothetical, it's real money leaving real bank accounts. But here's what makes this situation particularly complicated and particularly frustrating. This isn't a problem that's going to resolve itself quickly. And that's what I want to really dig into, because I think most people are treating this like a short-term news event when the financial reality suggests it could be something much stickier. Think about what has to happen for mortgage rates to come back down. The Fed needs to feel confident that inflation is under control. For inflation to be under control, energy prices need to stabilize. For energy prices to stabilize, the situation in the Middle East needs to de-escalate and stay de-escalated. And then on top of that, global shipping routes need to normalize. Supply chains need to recover, and businesses need time to adjust their pricing back downward. That's a lot of dominoes that have to fall in the right direction. And historically, that process takes months at minimum, sometimes years. We saw this exact dynamic after the supply chain disruptions of a few years ago. It took far longer for prices and rates to come back to comfortable levels than most economists initially predicted. The same stubbornness is embedded in this situation. Once inflation expectations get embedded into the market's psychology, they don't just disappear when the immediate trigger goes away. Investors, traders, and the Fed itself will remain cautious for an extended period, even after things start to cool down. So if you're sitting here thinking, I'll just wait for rates to drop and then buy or refinance, that is a completely understandable instinct, but it may not be the right financial move. Because here's the counterintuitive reality that financial advisors have been telling people for years. Timing. The interest rate market is nearly as hard as timing the stock market. Nobody rings a bell when rates hit the bottom, and while you're waiting, home prices may be moving, your rent may be increasing, and you're losing out on building equity. Let's also talk about what this means for people who aren't in the housing market at all, because renters are not immune to this, not even close. When mortgage rates go up and buying a home becomes less affordable, more people stay in the rental market longer than they planned. That increased demand for rental units pushes rents higher. We've already seen this effect at work over the past several years, and this new wave of rate pressure is going to add more fuel to that fire. So even if you don't own a home and you have no intention of buying one, your landlord's next lease renewal conversation with you is going to be influenced by everything we just talked about. Car loans are going up too. Personal loans are getting more expensive. Credit card interest rates, which are already at historically painful levels, are unlikely to drop anytime soon. The consumer who carries any kind of debt is feeling this pressure from multiple directions simultaneously. And the people who can least afford it are often the ones carrying the most debt relative to their income. Now, I want to shift to something practical, because I don't believe in making videos that just tell you the sky is falling without giving you something actionable. So let's talk about what smart people are actually doing right now in response to this environment. The first thing worth considering is your timeline. If you're planning to buy a home in the next 6 to 12 months, this rate environment should probably accelerate your decision-making rather than delay it. Here's why. If rates fall, you can refinance into a lower rate later. But if home prices continue to climb while you wait, the total cost of ownership could end up higher, even if rates eventually improve. The phrase in the real estate industry is marry the house, date the rate. It's a bit of a cliche at this point, but the underlying logic is sound. You can change the rate. You cannot change what you paid for the property. The second thing worth looking at is the type of mortgage product you're choosing. A lot of buyers are taking a harder look at adjustable rate mortgages right now than they might have in a lower volatility environment. An ARM can offer a significantly lower rate for the first 5 to 7 or 10 years. If you genuinely believe rates will be lower in years than they are today, an ARM might save you real money. But, and this is important, you need to understand the risk. If rates stay elevated or go higher, your payment adjusts upward at the end of that fixed period. This is not a strategy for people without solid financial cushion. Make sure you understand what you're getting into before you sign. Third, and this is something a lot of people overlook, is the value of buying down your mortgage rate with points. When you close on a loan, you often have the option to pay additional money up front in exchange for a lower interest rate over the life of the loan. In a high rate environment, the math on buying points can actually work in your favor if you're planning to stay in the home for a significant number of years. Talk to your lender or a fee-only mortgage advisor about running the numbers for your specific situation. Fourth, and I'd argue this is the most universally applicable piece of advice regardless of where rates are, is to aggressively work on your credit score. Your personal rate isn't just determined by the market, it's also determined by how risky the lender perceives you to be. Someone with an excellent credit score will consistently get meaningfully better rates than someone with an average one. In this environment where every fraction of a percentage point matters, closing that gap in your credit profile can save you tens of thousands of dollars. Fifth, look hard at your existing debt structure. If you're carrying high interest credit card balances, while also trying to save for a down payment, that's a mathematical situation worth examining carefully. Sometimes the highest return on your money isn't in a savings account or an investment. It's in paying off debt that's costing you 18 or 20% interest per year. Now, I want to zoom out for a second and address the bigger picture, because I think there's something important that often gets lost in these kinds of financial discussions. Geopolitical events are not new to markets. Wars, conflicts, sanctions, and diplomatic crises have been influencing global financial markets for as long as those markets have existed. And what history consistently shows us is that markets adapt. Economies find new equilibria. Supply chains reroute. Energy sources diversify. The world doesn't stop functioning because of a crisis, but the transition period, the time between the shock and the new normal, is genuinely painful for ordinary people who are caught in the middle. The families who are trying to buy their first home. The young couple who saved for years for a down payment, only to find the monthly payment has now jumped beyond what they can comfortably afford. The retiree on a fixed income whose variable rate mortgage just got more expensive. These are real people experiencing real hardship because of decisions made by governments and militaries on the other side of the world. And that is genuinely unfair. Acknowledging that reality doesn't mean there's nothing you can do about it. But it does mean that if you're frustrated and angry about watching your financial plans get upended, that frustration is completely legitimate. The system that connects military conflict to mortgage payments is real. It's not a conspiracy theory or a talking point. It's just the way globally integrated financial markets work. Energy prices affect inflation. Inflation affects interest rates. Interest rates affect every single American who carries debt or wants to borrow money. The sooner people understand that connection at a gut level, the better equipped they are to make decisions that protect their financial lives when the next shock hits. And there will be a next shock. There always is. Now, here's the thing. Understanding why your mortgage payment jumped is only half the battle. The other half is having the right tools and a real game plan to take back control of your money before the next shock hits. That's exactly why we built the Money Reset, our step-by-step financial reset workbook that walks you through rebuilding your budget, crushing high-interest debt, and freeing up cash fast, even in a high-rate, high-inflation environment like the one we're in right now. And if you're serious about buying a home this year, you'll want to grab our house down payment savings system too. It's the exact spreadsheet and guide thousands of people are using to hit their down payment goal months ahead of schedule, even with prices climbing. Both are waiting for you over at our website, and you'll find the direct link as the very first link in the description below. Go grab them now, because every month you wait in this market is real money out of your pocket. So, what should you be watching right now to understand where things might be headed? A few specific signals are worth tracking. First, oil prices. If you see Brent crude consistently trading above a certain threshold, that's inflationary pressure staying in the system. If oil starts to fall back down as the situation stabilizes, that's the first necessary step toward rate relief. Second, watch the monthly inflation reports. The Consumer Price Index and the Personal Consumption Expenditures Index are what the Fed actually looks at when making decisions. If those numbers start coming in hotter than expected, rate cuts move further away. If they cool down, the path opens up. Third, pay attention to what Federal Reserve officials are saying publicly. Their language around inflation expectations, around the timing of potential rate adjustments is genuinely informative. They telegraph their thinking in speeches and press conferences. You don't need to read between the lines extensively. They're usually fairly direct about what they're watching and what would need to happen to change their stance. And fourth, watch what's happening with the conflict itself. Military de-escalation, diplomatic progress, or agreements around shipping and oil infrastructure would be meaningful, positive signals for rate relief. Escalation, new fronts opening, or disruptions to oil infrastructure would be negative signals. You don't need to become a foreign policy expert, but having a rough sense of the trajectory of the situation will help you make more informed financial decisions. We are living through a moment where the abstract concept of geopolitical risk has become a very concrete line item in household budgets across America. $312 per month is not an abstraction. It's groceries, it's utilities, it's the difference between financial stability and financial stress for millions of families. The most powerful thing you can do in this environment is stay informed, stay proactive, and refuse to let these forces push you into financial paralysis. Paralysis is the worst outcome. Make a plan based on current reality, not the reality you wish existed. Consult professionals where the stakes are high. And keep watching this space because this situation is going to keep evolving and the financial implications are going to keep changing. If this video helped you finally understand the connection between what's happening overseas and what's happening to your wallet, do me a quick favor. Hit that like button. Share it with someone you know who's trying to navigate the housing market right now. They need to understand this. And subscribe, because we're going to keep breaking down exactly how the big events in the world translate into dollars in your pocket or dollars out of your pocket. That's what this channel is all about. I'll see you in the next one.